focus on how the shape of the real estate sector is going to be for 2022. Let me toss across to a chart that I had with HDFC's Keki Mistry on how he mapping out the year ahead and the credit environment in 2022.
I would expect the momentum to continue. There are several, so let's understand how this momentum came about. From 2017 to 2020, we saw that the tier 2 and the tier 3 towns continued to grow at a normal pace. But it's in the tier 1 cities and more so in the metros, in the heart of the big cities, in expensive properties, that there was a big slowdown. And that slowdown was there right from, I would say, mid-2017 or maybe late 2017, going right up to 2020, so a period of nearly 3 years. Now, in the course of those 3 years, people's income levels kept rising. So if you assume that the average income of a person rose by about 8% a year, 8.5% a year, then over a 3-year time frame on a compounded basis, income would have increased by close to 30%. But property prices did not change. Property price, what the property you could have bought in 2017 at a certain price, you'd have bought the same property at more or less the same price even in 2020. So therefore, in terms of affordability, there was a dramatic improvement. So this was one of the biggest factors which led to the pickup of demand in the metros, in the heart of big cities. And that coupled with the feel-good effect which was there in the economy, the speed at which the economy bounced back, the performance of the stock market. Today you see so many middle-class people who got some investment or the other in the stock market. And when markets do well, they all feel, at least on paper, they feel wealthy and therefore more willing to go and spend money. And we cannot ever deny the structural demand for housing in India because of the demographics where we have such a large proportion of the population who's young. So I think combination of all these factors led to the growth, and I see no reason why that growth should subside. I would expect that momentum to continue through 2022.
Sure. Analyzing the reasons behind it, and I guess, Keki, debt is cheap. That also sort of added that fillip to the realty boom. 2022, though, it seems like there could be a possible scenario, and more importantly, seems like an eventuality, that interest rate environment is going to change. At least globally, one can see those signs come in. What happens in that case? If interest rate trajectory is going to change come 2022, will that have a material impact on the housing demand?
I don't see it having a material impact. It will have some impact, but to my mind, the impact will not be very significant. If you look at, go back into history, look at the last 20, 25 years, we've never seen interest rates in India at the levels at which they are today. So this is more a function of the first and second wave of COVID, and therefore interest rates were low. But having said that, interest rates at a point of time have to rise. But let's purely theoretically assume that interest rates rise 100 basis points, theoretically, during the course of the year. Now, even if interest rates rise 100 basis points, the cost to a customer does not rise 100 basis points because there are fiscal benefits that are provided under the tax laws. So the interest that he pays on a housing loan is tax deductible up to a certain limit. The principal repayment of a housing loan is deductible up to a certain limit. And therefore, if interest rates go up by 100%, the cost to a customer goes up by a lesser percentage. How much lesser will depend on each individual, what his taxable income is and stuff like that. So it's not a full pass-through. When rates rise, the full pass-through goes to the consumer and vice versa. So I don't see it making a material impact. If we go back to history over the last 15, 20 years and plot interest rates in the system and demand for housing, we've not seen any very, very strong correlation. A little bit here and there, but not a very strong correlation. So there have been many, many periods in time in history when rates have been a lot, and I say a lot, I mean significantly higher than what they are today. And the demand for housing has also been very robust at that point.
The one reason has also been, Keki, like you were earlier alluding to, that real estate prices remained where they are for the last 3 years. Now that scenario somewhat seems to be changing. What added a fillip was, money was cheap, home loan rates were at an all-time low, real estate prices hadn't moved. And after that, there was a stamp duty cut as well, which was acting at an extra fillip in many of the states, especially Maharashtra as well as Karnataka. But it seems now with inflation drawing up higher, with steel, cement, even labor costs, beginning to see an uptake, that realty prices are going to get a little higher than there. And that they may have actually hit a bottom in that sense. Is that going to impact demand in any which way?
See, ironically, Aisha, you find that when prices are low and prices are falling, people sort of hold back on the decision to buy a house because you always believe that prices will go down still further. You know, in all this last 2 or 3 years, there was so much of talk about oversupply of real estate in Mumbai market in particular. And therefore, if I as an individual was looking to buy a house, let's say in 2018 or 2019, I would say, what's the hurry? Every day I'm reading newspaper reports that there's oversupply in the market. With so much of oversupply, prices aren't going to rise. Let me wait. I'll wait and buy a house 1 month, 3 months, 6 months, 12 months later. There's no hurry. But now, if I start seeing that prices actually have bottomed out and in certain cases are beginning to go up, then that will make me more sort of inclined to go forward and look to buy a house at this point in time. So if it's still not going to a level where it's going to be unaffordable. But a marginal rise in prices is always possible because in the last 3 years you had stagnant prices. And it's also specific to each project. Some projects have already seen some price rise, some projects have not. So it's very specific to the size of the project, number of units being constructed, stage of construction, and so on and so forth.
Quite an interesting anecdote there. What I also wanted to understand, Keki, was how the new credit cycle, that's 2022, is going to be different than what we've had in the last 2 years, for instance. And does 2022 also run a risk of defaults going up by any chance?
Well, I think defaults saw a rise in non-performing loans for most parts of the economy during 2021. Or 2020-21, probably as a result of the first and the second wave of COVID and the fact that it impacted some people more than it impacted others. But having said that, most banks are extremely well provided. So I would urge you or urge your viewers not just to look at the gross non-performing loan number of a bank or of a finance company, but look at the net non-performing loans, whether there has been adequate provisioning that the company has or the bank has made in respect of this loan. So I don't see defaults increasing because the pickup in economic activity that we've been witnessing, particularly since June of 2021, has been remarkable, and we see that right up till now, December 2021, as we speak. Now, having said that, we did see a little bit of a lull in the months of April and May during the second wave of COVID, but the economy bounced back very, very quickly. The first wave of COVID did impact the economy again for 2 or 3 months, but again from June or maybe July of 2020, we saw the bounce back. And then during the second wave, a little bit of a slowdown. So I don't see defaults increasing because people's ability to pay has increased significantly. Job opportunities have opened up. If you talk to people in sectors like IT and e-commerce and some of these sectors which employ a large number of people, all of them will tell you that there is wage inflation everywhere. So if there is wage inflation, it means that there is demand for people. If there is demand for people, then it means to that extent the ability of people to service their loans becomes that much easier or that much better. But at the end of the day, you must look at
when you're looking at the startup boom, for instance, is. Sure. Got your point. Yeah, the point I was making was it's the startup boom and look what it's done to the Bangalore market, for instance. But the other thing is that, Keki, real estate per se has a domino effect and a multiplier effect. It impacts a lot of other sectors as well. What I wanted to understand was whether or not capex cycle is likely to pick up in the year ahead.
Well, last 2 years, we've seen a weakness in the capex cycle. So the demand for credit has largely been from the retail sector, from individuals, from whether it's in terms of housing loans or, other kinds of personal loans. Demand has not been so much from the corporate sector. But when we talk to people in industries, some of them are now telling us that they are looking at, going for expansion plans and looking at some kind of a capital expenditure and stuff like that. So I mean, if the economic rebound is as strong as it has been, and if demand increases the way it has, then at some point of time, supply has to increase to cope up with that demand. And for supply to increase, you have to create more capex. So it's a matter of time now, whether it comes in the first quarter, second quarter, third quarter, I don't know. But I do believe that in 2022, we will see a pickup in the capex cycle.
Sure. But, just to take that point forward, given that we're at the fag end of the interest rate regime, will high interest rates or an uptick of any kind impact the capex cycle in any way, much unlike what you said about the retail loan category?
I would put the same, retail loans get the benefit of the tax benefit, but forget the tax benefit as far as the wholesale or the corporate loans are concerned. As I told you earlier, we've never seen interest rates as low as they are at this point of time. So Indians, by and large, Indian industry, by and large, is accustomed to a much higher interest rate regime than what we are seeing currently. So I don't believe a 50, 100 basis points increase in interest rates is going to make a material impact on the demand for credit. I don't believe so. I truly don't believe so. I think the demand for credit is a function of demand for the goods and services. And as economic activity continues to pick up, which we've been seeing all this while, and demand increases, manufacturers will be forced to produce more to be able to satisfy the demand. And to produce more, they have to go in for expansion, set up new capacities, which therefore means they have to borrow money.
Sure. Keki, green shoots in growth are clearly visible right now. Wanted to understand that from a macro perspective, with a fisheye lens, what is your own gauge of where the economy is headed? Because if we look at the indicators, whether it be the GST filings or for that matter, the last GDP print as well, it all seems to be indicating towards an uptick.
It certainly is showing a massive uptick. And we see this in day-to-day activity. Just to give you an example, I've been working right through this COVID period most of the time from office. And the amount of time it now takes to commute from home to office and back home has doubled over a period of the last 6 months. And today, the traffic we see on the roads is more than what it used to be in pre-COVID time. So economic activity is back to absolute normalcy. So if economic activity is back to normalcy, all the parameters that you're looking at, whether it is GST collections or tax collections or whatever else, have to logically show an increase. You see restaurants, you see hotels, all these hotels, all restaurants are crowded. Getting reservations in hotels or restaurants is difficult. So clearly, it shows buoyancy in the economy. And that buoyancy, I think we have to compliment both the government and the RBI for what they've done. RBI in terms of ensuring that there was enough liquidity in the system right through the first wave of COVID, not only ensuring that there was enough liquidity, but also ensuring that the liquidity reached every segment of the market. And the government for the measures it has taken in terms of supporting people during this difficult period. So I think compliments to both of them.
Yeah, absolutely. But at the same time, Keki, just analyzing, the strengths as well as weaknesses, what could be the key risks to the economy going forward? And what is it that would be derogatory to this long growth trajectory that we seem to have set off on already?
I would say the risk is some other event like COVID coming out of the blue, a major third wave of COVID, something which, starts derailing the economy, lasts a lot longer than what we had envisaged. But in that scenario, I would expect interest rates would also not rise. I don't think we will see that. I don't think we will see major lockdowns. You may see some kind of regional, stoppage of certain activities during this third wave. But that, to my mind, poses a little bit of a risk, but I don't see it's a major risk. I truly believe that the economy is back on the bounce. And I talk to a lot of foreign investors. Just one last thing, I talk to a lot of foreign investors, and I'm aware that there is a tremendous amount of money lying overseas looking to find its way into investment in Indian stock in some form or the other. You see this in the success of IPOs. You see this in the success of all these startups that we have witnessed during the last 1 year. And there is a lot more to come. Believe me, there's a lot.
Yeah, absolutely. The long India money is just waiting for these cream companies to actually IPO. And I guess that explains some of the successful ones as well. But that said, Keki, given that you've got your ears close to the ground and you're pretty much the financer to a large part of the economy in India, wanted to understand which sectors do you think could remain outliers? I mean, what we've seen is a big boom in the startup industry, in IT, tech, and all various subsidiaries of the IT and fintech universe. But outside of that, what sectors do you see actually leading the economy upwards?
I think even the core sectors, like if housing does well, for example, you mentioned about the linkages that housing has with so many other sectors in the economy, cement, steel, paint, power. So if housing does well, all these sectors in the economy will do. Not only that, if housing does well, a lot of jobs get created. Housing is one of the largest job creators in the country, whether it is in terms of direct jobs for, construction workers, masons, carpenters, plumbers, engineers, or it is indirect jobs which are created in these whole spate of ancillary industries associated with housing. So housing creates a lot of jobs, and jobs will result in more income in the hands of people. Income in the hands of people will lead to more consumption, and consumption therefore creates that demand, which will lead manufacturers to produce more and therefore create more capacity, which therefore means that the credit cycle also, or the capex cycle also starts picking up.